The 30th of March, 2026, will go down in history as one of the darkest days for Dalal Street. The Nifty 50 didn't just fall, it collapsed, losing nearly 500 points to close at 22,331. With the rupee crossing 95 and global oil prices screaming toward $120, investors are asking, is this a correction, or the start of a multi-year bear market? Today, we analyze the data behind the crash and predict what happens when the markets reopen after the holiday. The primary driver of this carnage is the escalating Iran-US conflict. Reports suggest a massive mobilization of American forces in the Middle East, the largest in 2 decades. Iran has responded with threats to rain fire on any ground incursion. For India, this is a double-edged sword. First, the supply chain through the Strait of Hormuz is under threat. Second, as a massive oil importer, India's trade deficit is exploding. Crude oil at $115 is a tax on every Indian company's bottom line. This war premium is why we saw the Nifty mid-cap and small-cap indices plummeting nearly 2.7% today. Let's talk about the FII bloodbath. In March 2026, foreign institutional investors have pulled out nearly 1 lakh crore rupees from Indian equities. This is the single largest monthly exit in the history of our markets. Why are they leaving? It's a flight to safety. With US Treasury yields rising and the Indian rupee at a record low of 95, foreign investors are losing money on the currency conversion alone. Even though domestic institutions, DIs, bought over 1 lakh crore this month, they simply cannot mop up the sheer volume of global selling. We are seeing a massive valuation reset where expensive Indian stocks are being dumped for safe haven assets like gold and US dollars. Now, looking at the charts, the Nifty has broken its crucial support of 22,800 and is now dangerously close to the 22,000 psychological floor. While the Gift Nifty is showing a minor recovery tonight, do not be fooled. This is likely a dead cat bounce. The RBI's recent move to curb dollar positions in banks shows how desperate the situation is for the rupee. Our stance for the next session, bearish. Until the Nifty convincingly crosses and stays above 22,700, every rally should be seen as an exit opportunity. The immediate support stands at 22,250. If that breaks, we are looking at 21,800. For tomorrow, or rather Wednesday, keep your position sizes small. The market is currently a slave to the headlines coming out of Washington and Tehran. Stay safe, keep your stop losses tight, and don't catch a falling knife. If you found this quantitative breakdown helpful, hit the like button and subscribe for daily market intelligence. We'll see you in the next one.